Following what was a dovish Fed rate decision yesterday, the US dollar and bond yields have both dropped. The key question is, what's next? Let's get into it. The euro dollar is an interesting currency pair to keep an eye on ahead of next week's ECB meeting. Next week, we'll also have the US jobs report and inflation data as well. So it could be a very interesting week in the FX markets. The last important week perhaps for this year before things calm down ahead of the year-end holidays. So the euro dollar is at the moment pushing higher on the back of the dovish Fed rate cut, where the Fed chair hinted that there could be more rate cuts in 2026, but kept his options wide open. And that surprised a few market participants who were looking for a hawkish rate cut, which didn't materialize. In any event, the euro dollar has now broken out and it will need to defend levels of prior resistance. So this area between 116.50 to, let's call it 116.80-ish. This area is very important now to hold as support, given that it was previously resistance prior to the Fed rate decision. So if that area were to break down, then I would expect follow-up technical selling on the euro dollar towards 114.60 to 115 area, where we also have the 200-day moving average converging as well. That's a massive area of support. But if the bullish trend remains intact, then from here 118 could be the next upside target, given its historical price reaction here and the fact that the euro dollar sold off from around that area previously. So that is the next line of potential resistance on the daily time frame. Above it, there's not much in terms of resistance until we reach the September high of 119.18. But if we get there, why stop there? Why not go to 120? So the euro dollar could well extend its gains into year end, depending on the outcome of next week's jobs data, inflation report from the US, and more to the point, the ECB rate decision and the signals the ECB President Christine Lagarde will give about the future path of interest rates in the Eurozone heading into the next year. The drop in bond yields as a result of a dovish Fed has caused the price of gold to remain supported after testing this area of support for a number of days here, and this area held at around 4,190 to around 4,170 area, I would say, the shaded grey region, where it was trading ahead of the FOMC rate decision. But this area has held now, and we've seen some upside follow through, breaking through some resistance levels. The key area of resistance to now take out is at around 4,275. This level, you can see it on a intraday chart. This is where previously the price of gold had rallied away from, hitting a double top here before breaking back below it. So this level is very important. It needs to be reclaimed by the bulls to give gold a fresh technical bullish signal, I'd say. So 4,270 is very important on the price of gold. And let's see if that will be retaken as I zoom back out to the daily time frame. And if that level were to break, then gold could well head to a new all-time high, reaching above 4,381. That was the previous high hit in October. So that's the bullish scenario. How about the bearish scenario? Well, we'll have to be prepared for all eventualities. And for me, a break below this shaded gray region would be very telling. I think if we break below that now, that could cause liquidation of leveraged long positions, triggering a sharp drop towards 4,100 initially, which is the next line of support, ahead of 4,000 next. So that's the bearish scenario. As things stand though, gold looks like it wants to break further higher, but as traders we'll have to be prepared for all eventualities and consider the downside as well as the upside risks. If you found this useful, make sure to like and subscribe, and for more content head over to cityindex.com. I'll see you in the next one. Take care.